Okay, so today's session is going to be recorded and I will email the slides out afterwards, so that way you can have access to this information at your convenience. With that, let's go ahead and get started. So thank you everyone for attending the PISD webinar series. We're going to be focused on investing opportunities for sustainable and mission-driven companies today. Okay, so our last webinar, we talked about advancing your sustainability journey through B Corporation and B certification status. And one of the benefits that we highlighted was raising capital. So with B Corporation or certification status, it's a really fantastic way to integrate your sustainability agenda into the core pillars of your company. It also helps attract and align investors since it has kind of a standard benchmark for measuring companies that investing companies can use to analyze your business. If you have any questions on B Corp or certification, feel free to email me. We will not be rehashing that today, but that webinar was recorded and posted to the PISD website, so you can also go back and watch that if you are curious. So why sustainable investing? So when we're talking about sustainable investing, we're really talking about investing capital in companies that are focused on achieving ongoing social or environmental benefits, not only just for the good of the world, but those companies are actually outperforming companies that don't have sustainability responsible investment strategies. So 1 out of every 6 sellers in the professional management in the U.S. incorporates SRI strategies, and those companies are actually outperforming the companies that don't have those strategies. So that's one kind of incentive for companies to be investing in, members of PISD, B Corps, and B certification companies. So we also look at demand over the next 15 years across food, water, and energy that are going to increase between 35 and 50%. Thinking about this in a financial sense, that means that raw materials are going to increase in cost in the coming future. So it's not surprising that sustainable companies who are focusing on the long term, increasing their overall efficacy and reducing their resource use, are going to outperform other companies because they're really taking account those increase in raw material costs going forward. We're definitely seeing this trend now, and it's going to continue into the future, almost up to 5% of world GDP for investing in those sustainable corporations. So your access to these resources is just going to continue to increase as time goes on. With that said, I'll introduce you to our resident expert on the line today, Gary Groff with New Resource Bank. He is the SVP of Business Development, and he leads their National and Organic Products practice. With that, I'll pass it off to Gary. Gary, you on there?
I am. Hi. Okay. Thanks, everybody, for getting on the line here. Let me just launch this here. Okay. Can everybody see my my page there? Sarah, can you see that? Just want to make sure I'm on there.
Yep, you're good.
Okay, great. Well, thanks again for everybody taking a couple minutes out of their day to talk. I'm covering the subject of financing your business, which is as I'm sure you know and have experienced, can be daunting and challenging, but it's also very rewarding and allows your business to grow. So hopefully I can give you some ideas on how to attract more capital for your business. As Sarah mentioned, my name is Gary Groff. I'm a SVP, Director of Business Development at New Resource Bank. New Resource Bank is about a 10-year-old bank. Also pretty active with a nonprofit called SF Made that works with 600 manufacturers here in San Francisco to help promote the manufacturing economy in San Francisco. And what I'd rather be doing is surfing, but if I got to do something else, banking is probably a close second. So one of the questions that we get pretty often, or that I field, is, should I be looking for debt? Should I be looking for equity? And I think that question ultimately is it depends. But a couple key components that seem to always jump out is, one is when you're looking for debt or equity or trying to make that decision, banks and debt providers are typically going to be looking backwards at your financials, as in looking at your historical financials. They're going to want to see positive cash flows to service proposed debt. So if you have a business that has been making some money, that you have new opportunities before you, and you can demonstrate that you can repay those loans, that's where the debt piece comes in. Of course, we're going to look at projections, and we're going to look at the macroeconomic aspects to it, but really we want to see some historical revenue and positive cash flow, where folks on the equity side could really look at the future of the business. As Sarah was just mentioning in those earlier slides about how some of these markets are growing exponentially, and how there's a lot of opportunities there. So if you have a product and maybe you're not quite profitable, but boy, you're really, the phone's ringing and you're getting slotted in many different stores, you can put some projections together and talk to folks on the equity side that would be that might be able to come in a little earlier than a bank would, and be able to help you with some growth capital. One of those big differences, what they're going to get for doing that is ownership of the business often. So if you can qualify for debt, leveraging existing cash flows is often very, very appealing, because you're retaining ownership in the business as opposed to the equity side. And then there's also the payback component that needs to really be looked at. Again, if you're taking a loan out, you got to pay it back, and that's obvious, but can be a real hit to cash flows, and maybe profitability isn't what you're immediately looking for. Maybe it's market share or expanding, your revenue, your top line revenue. So you really want to think about that when, even if your business is profitable, are you looking for debt? Are you looking for equity, and how that affects your business moving forward? So how would you choose your equity, or how would your equity investors choose you, might be another question. It's really aligning the vision of the investors with your vision. One of the key aspects of that is the exit conversation. Investors are typically, looking for an exit. They want to get repaid on the investment that they made, and typically those windows are often 5 years or less. Maybe they're 7 years. And if you have a vision of growing your business and holding it, frankly, creating a legacy type business, it would behoove you to have those conversations with those investors, because frankly, you're going to be getting married to them, and if you had different visions in mind, down the line, that can get pretty ugly. So I think really doing a whole lot of due diligence on the front side of who's going to be a partner in your business is incredibly important. Another thing to consider is not just the cash that an investor might be able to inject into your business, but what else can they bring to the table for you? We like to think of that term as smart money. Are they going to bring a network of advisors? Can they fill a gap in the management team? Have they done this before, or do they know a whole lot of people that have? Because cash is great, but cash and some expertise, that's where the true value can come in. And frankly, when you have those types of supporters in your business, banks can often come in maybe a little bit earlier than they would before, when they see that management team is so well-rounded, and frankly, that there's a balance sheet, that the business is solvent and could be able to absorb any bumps in the road that might occur, as the business moves forward. So very important to think about that. And I think you think about it in the same way as your employees and your supply chain. If you're thinking about all these things as really creating partnerships, I think you build resiliency in there. And I think when everybody's looking at a same mission, whether that's your CPA and your lawyer and your banker, if they know what you're doing and where you're going, often you can get some real buy-in from them and get that extra effort out of them because they've really because your mission of your business will really resonate with them. And I think that overall arching idea, it has been so relevant in the sustainable space. I heard Sarah mention, the last presentation was B Corps. Boy, we've seen so many B Corps really collaborate with other B Corps, larger ones helping smaller ones, investors coming in that are only looking for sustainable impact type investments. You have banks like us that will only work with these kinds of businesses, and I think I think it's really important because frankly, when things do go sideways, and they will go sideways at some point, if your team is put together with a cohesive alignment of values and mission, I think it could really help you navigate through the challenges that any small business is typically going to have. So then why would you choose debt? Well, I think in some ways that's obvious. I mean, it's access to working capital. You're not giving any ownership of the business away. If you can leverage your balance sheet and your cash flows to get more cash, to frankly unlock some cash. So that might be things like taking your accounts receivable and taking your inventory and getting some value from them, from a bank, to give you cash to be able to frankly put that next order out or put a larger order in for inventory that gives you some savings via economies of scale or what have you. And again, that reduces cash flow issues. So you could be a business that year end is profitable, but there's probably months where you're not profitable or you are from a cash flow perspective, and that's where banks can really be a great partner. They can be great partners for other things like term debt, if you want to buy the building or you need to buy a truck to deliver the goods or what have you. So that's the two avenues I think where they can be really important. And then kind of going back to that partner piece, I'm lucky to work with a whole large portfolio of businesses and frankly service providers that support those businesses. So I think from your banker, what you want to get is in some ways a trusted advisor, and that's from treasury needs to getting introductions and connections to other service providers, and frankly it can also be a second set of eyes. It could be a collaborative effort when you're putting projections together or you're thinking of expanding to a new territory or what have you. Sometimes if you have somebody that's had some good experience in the space that you're in, you might be able to get some good feedback from them too. So it's kind of just adding another partner, another collaborator onto your team. What do you need for debt financing? These are generalities here, but I think in general these couple things are true. You definitely want to have a couple years of established revenue. If you're just getting going, you have this great product, and maybe you have even POs, that's great, but that's probably not where a bank's going to come in and lend money at 6% that cost them 3%, right? So their margin's about 3%. So you can imagine the appetite for risk might be a little bit different than, for example, an equity investor who, by taking a small share of the business, could, frankly, get a significant return on that investment. So there's just a natural conservative nature to banking. That's kind of how the model works. They typically want to see established profitability. I can, however, work with companies that are nearing profitability, that show every aspect of their income statement is showing that they're going to be profitable very shortly, and that maybe we can come in and provide a working line or what have you. But typically banks want to see profitability. And then material assets and balance sheet. What we call that is a secondary source of repayment. So when a bank looks at something or a lender looks at something, they want to see a primary source of repayment. That's typically the cash flow. But they also need to demonstrate to auditors and so on and so forth a secondary source. And the secondary source is typically assets in the balance sheet, what the business might be worth, and sometimes looking at the key owners of the business to see if they have some material assets that might be able to support a a line of credit or some kind of debt. And that last one is where some of the collateral enhancement programs can really play a role. So say you have a business that is profitable, but you haven't been able to retain earnings because you've been investing it back in the business and you're growing. Well, that's where loans like SBA loans, Department of Agriculture loans, and the market that a lot of the businesses you're in would qualify for these Department of Agriculture loans that aren't always utilized. And what these programs do is they provide what banks say is collateral enhancement, but frankly what it is a bit of a guarantee. So it takes a little bit of the risk away for the bank to lend to a business that doesn't have both of those components met, and those components being cash flow, positive cash flow to service the business, as well as the assets behind it. So if you're short on one or the other, these programs, SBA, so on and so forth, can sometimes be a great program to come in and be able to get a bank to be able to get off the fence and frankly provide you that financing that you're looking for. So why do banks say no to loan applications? There's a host of reasons. I don't like saying no, frankly, but it needs to make sense for us to do transactions. We need to be sustainable ourselves. These are in no particular order, but the first one I have here is undercapitalization. Basically, that kind of goes back to that balance sheet piece. If the business doesn't have solvency, it's hard to bring on debt there to attract an approval for a debt piece if it shows that the business can't really absorb any bump in the road. So they typically want to see some kind of retained earnings or some kind of assets in that balance sheet. And that's what that debt to equity ratio is, a very important balance sheet covenant that many banks are going to put on a loan facility. Number two is insufficient historical profitability. I think that's probably pretty obvious, but how are you going to repay the loan? And if repaying a loan or a line of credit is based on all projections instead of what you've actually done in the past, it's typically going to be pretty hard to find a lender. Not impossible, but you really want to have your ducks in a row and be pretty close to profitability at least. And a lot of for smaller transactions, a lot of banks want to see a couple years of profitability, frankly, because they recognize the cyclicality of the macro economy, and they want to be sure that you could absorb a downturn like we just had 6 years ago, right? So that's kind of a good idea there. And then number three is this one is key, is unsophisticated financial statements. And I think the real key there is, if you're looking for a transaction, say it's under $500,000, that for almost any bank, frankly, is not a very big transaction for them. There's not, if you think of that 3% margin that I was just talking about and the overhead to service that and underwrite it and all those things, it's frankly hard to even make that a profitable transaction. But banks will do it because banks are excited about working with businesses that are moving into that space. And what they'll do is they'll work with a business that they're hoping to do some larger transactions with. I recognize if I can provide the first solution to business owners like you, that you're likely going to come see me for your second business solution. So what I can recommend is really get a good package together. Have a balance sheet that balances. Have monthly broken out income statement that highlights the challenges and how you've been able to overcome the challenges or are going to mitigate those challenges moving forward. If you can put that package together and make it frankly easier for the banker that you're working with, he or she is going to be more motivated to try to get that smaller transaction across the finish line. So if you can help them, often they can help you. So we really try to work with businesses that if they can demonstrate, and what that does is go into the 5 C's of credit. If you look at number 3 is character, and if I see robust financial statements that are fairly sophisticated, that gives me a lot of trust in that management team that they're going to be able to, again, kind of handle the challenges that owning a small business is going to throw at them. The other C's of credit: cash flow. Again, we want to see that cash flow. Collateral. Now we're going to the balance sheet. You want to see some assets in the business. Character, just talked about. Capital. Conditions. Conditions are more, can be macro conditions, right? I don't know if bank's not going to want to finance a business that's opening phone booths nowadays, right? Because the macro conditions have changed so dramatically. So we're always looking at that. And if you can help provide some color to lenders, that's always helpful, right? Like here's the pet food space or the pet industry. Here's, if you can provide that data, because frankly, what you're looking for is that partner to represent you. So what I do often is represent you as the business at the bank. So I take your transaction to the credit team, we underwrite it, and you help me answer the questions before they get asked, and that can really dramatically improve the possibility of an approval for a credit. So what we do that's a little different at New Resource Bank than traditional banks is we have you take a sustainability assessment. So we not only want to see positive cash flows in business and all those things that we talked about, but we'd like to see you make a commitment to sustainability. And you don't have to be all the way to the top right of this graph to qualify. What we want you to do is plant a flag and say, hey, I'm willing to move up into the right on this sustainability continuum, and maybe New Resource Bank and our partners can help us. So we'd like to, I love trying to provide a business case for sustainability. What we've done now is we've linked our assessment that we have all borrowers take. We've linked it to the B Corp assessment, but now it's a quick impact assessment. So if you're considering taking the B Corp impact assessment, you can actually take ours if you like, which is a abbreviated version. It gives you a really good idea. And what that does is it helps us show our depositors that we're taking their money and we're putting it to good. We're putting it to businesses that are making a commitment to running themselves in a sustainable way. So New Resource Bank, that's the sandbox that we play in. We are a certified B Corp. We are best for the world, I think, 4 years running. So we're pretty excited about that. But a lot of our success really is the success of the businesses that we lend money to. So we lend to many nonprofits to many nonprofits, but many B Corps, folks in the social venture network space, investor circle space. A lot of these impact businesses that really, frankly, make us proud to work with them. We work with triple bottom line businesses, people, planet, profit, sustainable business. So these are the areas that we have focus on. Organic and natural products. I've been running that group at the bank here for a number of years. We have a strong portfolio there. So if you have a product that's in that space, we might have some good expertise that you might not experience from a generalist at a bank that might not know the market as well. We do a significant amount of lending in the clean energy space, project financing, solar companies, biodigesters, all that good stuff, and green real estate. So we're helping real estate owners make their buildings much more efficient and sustainable. And frankly, I think we get a better asset out of it, and they get a better environmentally performing building out of it. And I think that's what makes us unique is working with businesses that, we add value, frankly. I think we, try to create trusted relationships with our businesses, make contacts where we can. We know how to structure deals. We know our space, anything from fair trade to any of those different type of financing mechanisms that businesses like yours might have. I like to think we have some pretty good experience in the space. and a powerful network of businesses and nonprofits. So, a lot of what we do is frankly just putting businesses together to help each other. And we're part of something bigger. So we're one of 28 banks that are in the Global Alliance for Banking on Values. That is currently, over $100 billion in assets. They just came out with a report not too long ago that took the financial performance of these 28 banks and compared it to the 5 largest banks in the world, and we outperform those banks. So I think there is a business case for sustainability, not only for us at the bank, but we're seeing that with so many businesses that I work with have been able to outperform the traditional businesses that are out there because what they're doing is resonating with their consumers. They're attracting better employees. They're attracting equity from folks that want to have an impact, and they're attracting networks of collaborators that are really interested in what they're doing. And I can't underemphasize the value that I've seen businesses get from plugging into this network. What else can you do? Look at your company's mission, vision, values. I think that's, one of those things that easily gets overlooked when you're trying to run a business and you're the chief cook and bottle washer. But, if you don't put that into the DNA of your business now, it's really harder to insert later. And, look at your partners and your investors and your suppliers. If you can create real meaningful relationships with them, again, they can really be helpful in tough situations as well as good situations. Take the B Corp's quick assessment. I think that the great thing about taking that assessment is it gives you great ideas on how to improve, and a lot of those improvements they'll show you the benefit of doing it, and often it's a financial benefit, but again, maybe it's I think that the hardest thing that we experience is finding good employees. And boy, I think we find a whole lot better employees at New Resource Bank than Wells Fargo does or what have you, because I think we find the folks that really can relate to the mission that we have, and we get that extra work out of it. And frankly, I think as a customer, you get that extra service out of it. Internally, establishing a green team is another great idea. It helps you as a business owner to frankly empower others in your organization. And in summary, being a business that embraces the triple bottom line, I think, creates a culture that, again, you can attract employees, investors, supply chain, and consumers that all relate to your mission and can move your business from maybe a commodity-like business where one dog food is the same as the other dog food, to having a real relationship with them where they might not be as concerned about a cost increase of 20 cents or something like that. If you can move from a transactional relationship to a true relationship with your consumers, incredibly powerful, and it frankly makes your business incredibly resilient.
All right. Thank you, Gary. Apologies, everyone. I know we are a little bit over. So if you have any questions, feel free to ask them now. If you need to run, that's totally fine. I will be sending a recap email with both my information and Gary's information so you can ask us directly. All right. So any questions before we end the webinar? All right, well, thank you everyone for joining, and I will send a follow-up email shortly. Bye, everyone.